information in this video is for educational purposes only, and is not intended to provide financial, legal, or tax advice. You should consult with a licensed attorney, tax professional, or financial advisor for advice concerning your specific situation. The information contained in this video does not constitute an offer or solicitation to buy or sell any property or financial instrument.
Homebuyers are facing reduced purchasing power as mortgage rates have risen, leading to increased potential monthly payments. However, waiting for rates to drop again may not always be feasible. An alternative to consider is to lower your mortgage rate through a buy-down process. What is a mortgage buy-down? A mortgage buy-down is an option to lower monthly mortgage payments and make it easier for buyers to qualify for a loan, or afford a more expensive home, by paying a one-time lump sum upfront, resulting in a lower mortgage rate. This upfront payment, or as it is called, buy-down fee, is typically paid to the lender or a third party, who then uses the funds to temporarily lower the interest rate on the mortgage. The process of buying down a mortgage can vary depending on the lender and the type of buy-down rate desired. There are several methods of achieving a buy-down, and the specifics will be determined by the lender and your choice of a permanent or temporary buy-down rate. There are two main types of mortgage buy-downs: temporary buy-downs and permanent buy-downs. A permanent buy-down is a type of fixed-rate mortgage where the interest rate is permanently reduced in exchange for an upfront fee. The fee is paid in installments over the first few years of the mortgage, and the lower interest rate applies for the entire loan term. A temporary buy-down is a type of adjustable-rate mortgage where the interest rate is lowered for a set period of time, typically 3 to 5 years. The borrower pays an upfront fee to the lender, which is used to subsidize the lower interest rate. After the buy-down period ends, the interest rate will adjust to the market rate, which could result in higher monthly payments. How much does it cost to buy down a mortgage rate? There are a few different ways to finance a mortgage buy-down. The most common method is through points, which are a type of prepaid interest that can be used to buy down the interest rate. 1 point is equal to 1% of the loan amount, so if you're taking out a $200,000 mortgage and you want to buy down the interest rate by 1 point, you would pay an upfront fee of $2,000. Another way to finance a mortgage buy-down is through lender credits, which are credits applied to the borrower's closing costs. For example, if a lender is willing to give you a credit of $2,000 to buy down your interest rate, you could use that credit to offset your closing costs, which could reduce the amount of cash you need to bring to closing. Who can purchase a mortgage buy-down? Mortgage buy-downs can be paid by either the borrower or the seller, depending on the terms of the mortgage agreement. In some cases, the seller of a property or a builder may offer to pay the buy-down fee as a way to make the property more attractive to buyers. This can be especially common in a buyer's market where there is a lot of competition for properties. The seller may offer to pay the buy-down fee in order to make the property more attractive to buyers, or make it easier to qualify for the loan, which helps the property stand out from other properties on the market. It's important to carefully review the terms of the mortgage agreement, and understand who is responsible for paying the buy-down fee before committing to a mortgage. If you have any questions or concerns, it's always a good idea to speak with a financial professional or a mortgage lender to get more information. What are the different ways to buy down a mortgage? There are several ways that a temporary mortgage buy-down can be arranged. The 3 most common arrangements are 3-2-1 buy-down, 2-1 buy-down, 1-0 buy-down. 3-2-1 buy-down refers to a temporary buy-down mortgage, where the interest rate is lowered by 3% the first year, 2% the second year and 1% the third year. This type of buy-down is typically used to help a borrower qualify for a mortgage they wouldn't be able to afford otherwise. The interest rate will then adjust to the market rate after the third year, which could result in higher monthly payments. A 2-to-1 buy-down works similarly to the 3-2-1 buy-down, but the interest rate is lowered by 2% in the first year, and 1% in the second year. This type of buydown is typically less expensive than a 3-2-1 buydown because the interest rate reduction is less severe in the first 2 years, and can be a good option for those borrowers who are less in need of interest rate reduction, or have lower budget upfront. 1-0 buydown is a temporary buydown mortgage where the interest rate is lowered by 1% in the first year and does not change for the remaining years. This type of buydown is less common and typically less popular than the other two types, as the interest rate reduction is minimal, resulting in a small reduction in the monthly payments and may be considered not as much value as the other two types. Does buying a down mortgage pay off? A mortgage buydown usually only makes sense if the buyer intends to own the home for an extended period of time. In other words, the buyer must be able to reach the break-even point, the time it'll take to recoup the cost of the discount points. This changes depending on the loan's term, interest rate, and amount. It's important to consider the long-term implications of a mortgage buydown before deciding if it's the right option for you. While a buydown can lower your monthly payments in the short term, it can also result in higher payments in the long term if the interest rate adjusts or you decide to refinance. It's also worth considering if you have the cash available to pay the upfront fee, as it can be a significant cost. In summary, mortgage buydowns can be a useful option for borrowers who are looking to make their mortgage more affordable in the short term. Still, it's important to understand how they work and consider the long-term implications before deciding if a buydown is right for you. Consult with your mortgage lender to find the best mortgage buydown arrangement for you, or whether a mortgage buydown makes sense at all for your situation. Thank you for watching. I hope you found this video helpful. If you did, please consider liking, commenting, and subscribing to my channel for more real estate tips and insights.
The information in this video is for educational purposes only, and is not intended to provide financial, legal, or tax advice. You should consult with a licensed attorney, tax professional, or financial advisor for advice concerning your specific situation. The information contained in this video does not constitute an offer or solicitation to buy or sell any property or financial instrument.